Imagine it's 28 September 2022. You are a 57-year-old school caretaker living in Derby, England. You wake up before dawn in a red brick semi-detached house with a kettle that whistles louder than the morning news. You have worked for decades, paid into your pension without fuss, and kept a small savings account for boiler repairs, birthdays, and the kind of bad month every family eventually gets. Your wife does the weekly shop with a handwritten list. You drive the same hatchback you have owned for years, and retirement feels close enough to touch, like a light glowing through fog. You do not trade stocks, you do not sit in dealing rooms, and you have never once in your life said the word guilt in ordinary conversation. But by lunchtime, men in London are staring at screens in panic, and the quiet future you thought was already built starts to shake like a bridge in high wind. If you have ever wondered why a market most people never think about can suddenly threaten pensions, banks, governments, and the price of almost everything, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before. And it almost never looks dangerous until the moment it does. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. That afternoon, the Bank of England stepped into the bond market with an emergency promise to buy long-dated government bonds. Not because Britain had run out of money that morning, not because school caretakers in Derby had done anything wrong, but because a hidden machine inside the financial system had begun to tear itself apart. Pension funds using something called liability-driven investment, or LDI, which is really just borrowed exposure dressed up as safety, were being hit with margin calls. Margin calls mean someone who borrowed to make an investment is being told to put up more cash immediately or start selling. They did not have enough cash, so they sold bonds. But the selling made bond prices fall even faster. That forced even more selling. It was like trying to put out a kitchen fire with petrol. More than $1 trillion was tied up in these LDI strategies, and the Bank of England later bought $19.3 billion of gilts to stop the spiral. In less than a week, a market that was supposed to be the safe floor under retirement had become a trapdoor. And that is the heart of the story. When most people think of financial collapse, they think of 2008 and housing. But history shows that bond markets, especially government bond markets, sit beneath far more of the system than mortgages ever did. They are the beams in the basement. When they crack, the whole house begins to move. Before we go further, there is something important to understand. A bond is just an IOU. A government, company, or bank borrows money today and promises to pay it back later with interest. That sounds simple, and on the surface it is. But the bond market is not just a place where people lend money. It is the operating table of the modern economy. Governments fund wars, welfare systems, and deficits through bonds. Banks park money in them. Pension funds build retirement plans on them. Insurance companies use them to match future promises. Hedge funds borrow against them. And central banks treat them like the cleanest shirt in a dirty laundry basket. Here's the part most people miss. Bond prices fall when interest rates rise, and they fall hard when rates rise fast. A low-rate bond issued yesterday suddenly looks ugly when a much higher-rate bond appears today. So the old bond has to drop in price to stay competitive. That sounds manageable until you remember how much of the system is built on the idea that bonds are safe, liquid, and always saleable. Safe means unlikely to default. Liquid means easy to sell quickly for cash. But history keeps showing that safe does not mean stable in price, and liquid does not mean liquid in a panic. Think of the bond market as the steel frame inside a skyscraper. Most people never see it. The carpet, the paint, the glass, the nice lobby, that is what gets attention. But if the steel bends, every floor above it starts to groan. A bond market crisis usually begins with one of 3 things. Either investors stop trusting a borrower to repay, or interest rates rise so fast that old bonds become deeply less valuable, or too many institutions have borrowed against bonds and must sell at the same time. Sometimes all 3 happen together. When they do, the problem does not stay inside the trading screens. It jumps into pensions, taxes, jobs, bank accounts, and politics. The crisis stops being financial and becomes personal. This brings us directly to the first part of the story. On 17 August 1998, Russia did something governments always insist they will never do until the day they do it. It defaulted on its domestic debt, devalued the ruble, and imposed a 90-day moratorium on some foreign payments. A moratorium is a pause on payment, which sounds polite, but to anyone waiting to be paid, it feels like the floor disappearing. The default centered on short-term government bills known as GKOs. These were supposed to be temporary funding tools. Instead, they became a treadmill Russia had to keep running faster and faster just to avoid falling. Throughout the 1990s, Russia financed itself with short-term debt at punishing interest rates. It was borrowing short and hoping confidence would hold. Borrowing short means your debt comes due soon, so you must refinance again and again. It is like paying your mortgage with a credit card every month and praying the bank never questions you. Foreign investors piled in because the yields were high. High yield means high interest payments. It also usually means high danger hiding behind the smile. By mid-1998, foreign investors held roughly a third of the GKO market. Oil prices were weak, tax collection was poor, confidence thinned out. The Asian financial crisis had already made investors jumpy. Then the crowd moved. Once investors started pulling away, Russia could not roll the debt cheaply. To roll debt means replacing maturing debt with new debt. The old machine no longer fed itself. The face value of the domestic debt covered by the 1998 restructuring was about $44 billion at the pre-crisis exchange rate. That was not a small corner of the system. It was the hinge holding the door. When the hinge snapped, the door came off. For ordinary Russians, the crisis was not a chart. It was wages delayed, savings damaged, prices jumping, and trust vanishing. Import prices surged after the ruble fell. Shops repriced goods almost overnight. Families who thought they were being prudent found that prudence is not much protection when the currency itself becomes a moving target. Retirees saw fixed incomes buy less. Workers were sometimes paid late or not at all. The state had promised order. Instead, it delivered smoke. And the damage did not stay in Russia. This is where history gets uncomfortable. The Russian default helped trigger the near collapse of long-term capital management in the United States, a giant hedge fund run by famous traders and advised by Nobel Prize winners. It had used enormous leverage, which means borrowed money multiplied many times over, to bet on tiny gaps between bond prices narrowing. That works beautifully until panic widens those gaps instead. Then leverage stops being a ladder and becomes an anvil. The Federal Reserve had to coordinate a rescue because the positions were so interconnected that one fund's failure threatened the wider system. The lesson was stark. A sovereign bond crisis in one country could ricochet through supposedly sophisticated institutions half a world away. Government debt was not a quiet backwater. It was a junction box wired into everything. When yields surged and refinancing failed, the blast wave spread through banks, currencies, and leveraged bets built on the assumption that sovereign debt markets would remain orderly. The same mechanism would return again and again. Trust weakens, prices fall, collateral shrinks, forced selling starts. Then the crisis feeds itself. Here's something I want you to think about before we go further. If the debt issued by a government can shake pension funds in one country and nearly topple a hedge fund in another, what exactly counts as safe in a financial system built on promises? Drop your answer in the comments. Seriously, because what I am about to show you next is the part of this story that most people never hear, and it changes everything. This leads to the second part of this story, and it begins in Argentina. On 1st December 2001, Economy Minister Domingo Cavallo announced the Corralito. The word sounds almost playful. In practice, it meant a cage around people's own money. Cash withdrawals from bank accounts were limited to 250 pesos or $250 per week. Imagine going to work all month and then being told you may touch only a small slice of what already belongs to you. Imagine trying to pay a contractor, help a sick parent, or calm a frightened child with a government explanation instead of cash. Argentina had spent years defending a one-to-one peg between the peso and the US dollar. A peg is a fixed exchange rate. It can create confidence for a while, like painting over damp walls, but if the underlying economy is weak, the paint does not solve the leak. The country borrowed heavily. Growth slowed, tax revenues weakened. Investors began to doubt that the government could both defend the currency and keep paying its debts. Bond yields rose. Rising yields mean lenders demand more interest because they sense more risk. That makes it more expensive for the government to refinance. The rope tightens. By the end of December 2001, Argentina defaulted on more than $80 billion of sovereign debt, the largest sovereign default in history at that time. Some accounts put the broader figure much higher depending on what was included, but the core point is clear. The government had promised more than markets believed it could repay. Once that trust broke, the banking system was dragged into the same undertow. Depositors rushed to pull money out. The state froze access to stop a run. A bank run is when too many people demand their money back at once, exposing the fact that banks do not keep all deposits sitting in a vault. The run was not irrational. It was the public sensing that the polite language of finance had reached its breaking point. What did ordinary people experience? They experienced humiliation, long lines outside banks, ATMs without cash, savings trapped while prices and fear moved freely. Small businesses struggled to pay suppliers and staff. Street protests spread. Riots followed. In December 2001, the unrest helped topple President Fernando de la Rúa. Several presidents cycled through in rapid succession. That is another pattern history offers with chilling consistency. When bond markets crack badly enough, The damage moves from balance sheets to governments. Political stability becomes just another asset repriced by fear. And there was a deeper cruelty in the Argentine case. Many middle-class families had done exactly what they were told to do. They kept money in the bank. They believed the peg. They trusted the rules. Then the rules changed around them. The crisis was like a theatre where the exits were painted on the wall instead of cut into it. The wealthiest and best connected often had more ways to move money early, hedge in dollars, or structure businesses abroad. The average saver did not. By the time the danger was visible to everyone, it was already too late for many. Now here is where it gets interesting. Argentina's crisis was not just about too much debt. It was about the bond market acting as a truth machine. For years, politicians and officials can say the system is manageable, but bond investors ask a crueler question. At what price will we keep lending? When the answer becomes not at any sane price, governments run into a wall. If debt is the fuel, confidence is the oxygen. Remove the oxygen, and the engine dies fast. The same mechanism appeared again in 2015, this time inside the euro area, a part of the world many assumed could never produce a classic sovereign funding panic. Greece had already spent years inside a debt crisis that began in 2009 and erupted into full rescue mode in 2010, when Europe and the IMF agreed to a $110 billion package. That first bailout did not end the story. It merely bought time. Greece's economy then contracted by roughly a quarter from its pre-crisis size. Unemployment climbed above 27% and youth unemployment went above 60%. That is not a downturn. That is a generation having the floor removed from beneath it. In March 2012, Greece carried out the largest sovereign debt restructuring in history, reducing its debt stock by about $107 billion through the so-called private sector involvement deal. A restructuring means changing the terms, because full payment on the original promise is no longer realistic. Bondholders took massive losses. Yet even that did not restore normality. By June 2015, after failed talks with creditors and a freeze in support from the European Central Bank, Greek banks shut their doors and capital controls were imposed. ATM withdrawals were capped at €60 a day. Think about that. You live in a developed European democracy, use the same currency as Germany and France, and you are queuing for €60 a day from a machine that may or may not still be stocked by evening. Pensioners waited outside banks, families rationed cash, businesses that needed imported medicine, parts, or inventory faced special approval procedures. Money had not disappeared in the physical sense, but access to it had narrowed like the neck of an hourglass. That is what a bond market crisis does after it passes through banks and politics. It turns a national crisis into 1,000 household negotiations. And this is where history gets uncomfortable. Greece showed that even membership in a currency union does not erase bond market discipline. It can actually intensify it. Greece could not print its own currency to ease the squeeze. It relied on external financing, official support, and the willingness of others to continue backstopping its banks. Once markets doubted repayment and growth, bond yields soared to levels the state could not live with. Then came austerity, which means spending cuts and tax hikes meant to reassure lenders. But austerity in a depression can feel like asking a drowning man to become lighter by exhaling faster. Ordinary people carried the weight. Hospitals faced shortages, young workers emigrated, families relied on grandparents' pensions, informal support, and cash hidden at home. The Greek crisis reminds us that bond market stress is not only a story about defaults. Sometimes the bond market does not have to fully break a country, it only has to corner it. Once that happens, policy choices become narrower, harsher, and more humiliating. Look at what happened next. The damage in Greece was not only financial, it was social time stolen from millions of people. When an economy shrinks by about 25%, whole life plans are pushed off a cliff. A young graduate delays leaving home. A couple postpones children. A skilled worker boards a plane to Germany, Britain, or Australia because the local job market has become a locked room. In many countries, people think of bond yields as a concern for ministers and bankers. In Greece, bond yields became a shadow over weddings, births, careers, and migration. A number on a screen in Frankfurt or London translated into whether a pharmacy could pay an importer or whether a family business could survive another month. This is the part many viewers never get shown. Sovereign debt crises are often described as if a nation itself made a single bad choice and paid the bill. But nations are not single actors. They are pensioners waiting in line, nurses doing double shifts, taxi drivers counting cash at midnight, parents deciding which expense can wait. The bond market is like a cold courtroom where millions of people are judged by a few variables they do not control. Tax revenue falls, growth disappoints, politics turns chaotic, Refinancing costs rise, and suddenly the public is told that sacrifice is unavoidable. That word sacrifice is almost always carried by people who had the least voice in creating the excess. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. Russia in 1998, Argentina in 2001, Greece in 2015. Different countries, different currencies, different political stories, same mechanism. A state depends on rolling debt. Investors begin to doubt repayment, growth, or currency stability. Bond prices fall and yields rise. Rising yields make refinancing harder. Banks and funds holding the bonds weaken. Depositors or creditors pull back. Policymakers try emergency measures. The measures calm one fire but feed another. Then ordinary people discover that what was called liquidity in calm times was really confidence wearing a borrowed coat. The same mechanism, different countries, different decades, same result. Bond markets are not merely measuring devices. In crisis, they become transmission belts. They carry stress from abstract promises into concrete pain. And once leverage is involved, the speed increases violently. Leverage means borrowed money piled on top of borrowed money. In calm times, it makes returns look smooth. In a panic, it works like black ice. You do not notice it until you have already lost control. This is why the title of this video matters. In 2008, the core problem began in housing finance and mortgage-linked securities. That was huge. But the bond market is even broader. According to SIFMA, global fixed income outstanding reached $140.7 trillion, with the U.S. fixed income market alone at $55.3 trillion. And the OECD says OECD government bond debt is projected to hit $56 trillion in 2024, up about $30 trillion from 2008. That means the foundation stones are larger, more interconnected, and more politically important than they were when Lehman Brothers failed. And the modern system has already shown how fragile that can be. In March 2020, as the pandemic shock spread, even the U.S. Treasury market, the market many treat as the safest and deepest on earth, seized up in what the New York Fed called a global dash for cash. Investors sold sovereign bonds for cash. Liquidity deteriorated. The Federal Reserve's weekly Treasury purchases peaked at about $350 billion in late March just to restore market functioning. Think about how extraordinary that is. The safe harbor itself was taking on water. At this point, the pattern becomes impossible to ignore. Bond market crises are rarely about a single villain. They are about structure, too much debt, too much short-term refinancing, too much leverage built on the assumption that government bonds can always be sold smoothly, too much political comfort taken from low rates that do not stay low forever. Collapse is not a thunderclap. It is a bridge cable fraying strand by strand until one windy day reveals what has been weakening for years. Who gets hurt the most when this happens? History gives a painfully clear answer. People who depend on fixed claims, predictable cash flow, and easy access to their own money, pensioners, salaried workers, small business owners, families with savings trapped in domestic banks, people whose wealth exists mostly as entries inside institutions that have promised stability. Look back to Weimar Germany in 1923. This was not a bond sell-off in the modern screen-based sense, but it was absolutely a sovereign debt and currency disaster. And it showed what happens when the state destroys the value of fixed claims. Germany, burdened by war debts and reparations, financed itself through money creation on a catastrophic scale. Hyperinflation, which means prices rising so fast that money loses value almost by the hour, tore through society. A loaf of bread that had cost 250 marks in January 1923 reached around 200 billion marks by November. Middle-class savers saw insurance policies, bonds, and cash savings turn into paper ghosts. People rushed to spend wages before prices rose again by afternoon. The careful were punished. The indebted sometimes found old debts easier to repay in ruined currency. That is one of history's ugliest reversals. Now compare that with Cyprus in 2013. After the country's banking and sovereign troubles spiraled, uninsured deposits above $100,000 at Bank of Cyprus were hit with a 47.5% haircut. A haircut means part of the money is simply taken to absorb losses. Again, look at who was exposed. Business owners with payroll accounts, families using banks as safe storage, anyone who believed that money in the account and money in the hand were almost the same thing. They are not the same in a crisis. One is a claim, the other is possession, and go back to Britain in 2022. The typical retiree did not see a bank line or a deposit haircut. But the threat was still real. Pension funds using leveraged LDI strategies were hit because gilt yields jumped after the mini-budget shock. The crisis was not that pensions had no assets. It was that those assets could not be turned into the right kind of cash fast enough to meet collateral calls. A retirement system can look solvent on paper and still fail in motion, the way a car can have a full tank and still spin out on black ice. Who walks away better? Usually not the people with the highest IQs, usually the people with flexibility, those with less leverage, those less dependent on a single institution, a single currency, a single rollover point, or a single government promise. In Argentina, people who had already shifted part of their lives into dollars or real assets were often in a better position than those entirely trapped inside the domestic banking cage. In Greece, families with broader support networks, foreign income, or fewer immediate cash needs endured better than those living week to week. In inflationary collapses like Weimar, people with access to hard assets, inventory, or foreign currency often preserved purchasing power better than those holding fixed nominal claims. Nominal means the number printed on paper, not the real buying power that number can command. The human cost is always uneven. That is why bond crises are so politically explosive. They do not spread pain evenly across society. They sort people by access, timing, and financial plumbing. The insider gets an email, the wealthy wire funds, the multinational invoices abroad. The pensioner waits, the shopkeeper counts notes, the public is told the system is being stabilized. Often that is true. But stabilized for whom, and after what losses, is the question history keeps asking. And this is where the present begins to rhyme with the past. Governments emerged from the pandemic with far more debt. The OECD says government bond debt across OECD countries is projected to reach $56 trillion in 2024, around $30 trillion more than in 2008. In the United States, net interest outlays reached $949 billion in fiscal year 2024, up $239 billion from the year before. That does not mean an immediate collapse. History is more subtle than that. But it does mean the machine is now larger, heavier, and more sensitive to interest rates than it was when many people still treated 2008 as the ultimate benchmark. Now observe what all of these cases have in common with those modern numbers. When debt piles up in a low-rate world, institutions quietly build habits around cheap financing. Governments run bigger deficits. Companies refinance lazily. Property owners borrow as if rates are a law of nature. Pension funds reach for leverage. Hedge funds build relative value trades, which means bets on tiny price gaps using large borrowed positions. Banks load up on longer-dated securities because they seem safe. Then rates rise or confidence weakens, and the whole landscape changes slope. What looked like a gentle hill suddenly reveals itself as loose gravel. That is why even advanced markets can wobble in ways that shock the public. In March 2020, the US Treasury market required extraordinary support to keep functioning. In 2022, Britain had to backstop its long-dated gilt market to stop pension-driven forced selling. These were not poor countries with no institutions. These were the markets used as global collateral and policy anchors. When even they show stress, history suggests we are not looking at isolated accidents. We are seeing the same old law of debt in a more complex costume. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing. And it might change everything. What then did the survivors do differently? Not the lucky, not the politically connected, the survivors. The historical record shows that those who came through these periods largely shared three characteristics. First, they respected liquidity. Liquidity means access to usable money when everyone else is scrambling. In crises from Argentina to Greece to Britain's pension shock, the problem was often not theoretical wealth, but immediate access. People and institutions that had breathing room, unencumbered cash, shorter chains of obligation, and fewer urgent rollover needs were harder to break. Second, they distrusted single points of failure. A single point of failure is one weak link that can collapse the whole chain. History shows that people who depended entirely on one bank, one currency arrangement, one leveraged strategy, or one stream of income were far more fragile. Those with some spread of risk, whether through geography, asset type, business model, or funding source, were better able to absorb the hit. This is not modern self-help language. It is one of the oldest lessons in financial history. Never build your whole life on one bridge if the river below is prone to flooding. Third, they recognize that yield is not safety. High yield is often the price paid to persuade lenders to ignore danger. Russia's debt offered dazzling yields before default. Argentine promises looked stable until they were not. Greek bonds paid investors for taking what turned out to be real sovereign risk. Even supposedly safe bonds can become dangerous if leverage sits on top of them, as Britain showed in 2022, and as US Treasury stress hinted in 2020. The survivor mindset was not about predicting the day of collapse. It was about refusing to confuse calm with permanence. There is one more pattern worth noticing. The people who survived mentally as well as financially were often those who understood the story early. They did not need to know every formula. They only needed to understand the mechanism. Debt must be rolled. Confidence can vanish. Bonds underpin banks, pensions, and collateral chains. If the bond market breaks, the damage travels faster than official reassurance. Once you see that, history stops looking like a collection of random disasters. It starts looking like weather, different clouds, same pressure system. So let us return to that caretaker in Derby on 28 September 2022. He finished his shift. He locked doors. He drove home through ordinary traffic. The supermarket was still open. The lights still worked. No one on his street spoke about repo markets or collateral spirals over dinner. And yet, for a few days, the retirement system beneath him had been close enough to failure that the central bank had to step in and buy time. That is the deeper lesson here. Bond market crises do not always arrive with dramatic footage on day one. Sometimes they arrive dressed as a policy error, a technical funding problem, a pension mismatch, a liquidity issue, a currency defense, a temporary bank holiday, a necessary restructuring. The language changes, the mechanism does not. The mechanism is simple and old. Too many promises, too little trust. Too much leverage, then forced selling, then human consequences. History does not tell us what will happen next, but it does tell us what has happened before and what the pattern suggests we should never dismiss. A world built on debt can tolerate many things. It can tolerate politics, waste, denial, even long stretches of bad policy. What it cannot tolerate forever is the loss of confidence in the market that finances everything else. When that market breaks, 2008 stops looking like the only template. It starts looking like one chapter in a much longer book. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more. And I will see you in the next one.